I don't want to say never, but I don't think they're ever going to let it get down to the 70s, maybe even the 80s again. Guarantee you that strategy has no idea what the ceiling is because they are redefining the category. And you could foresee a scenario, and especially with all this, giant AI CapEx build out, where all of your major tech companies issue a preferred. I think in the first maybe 2 months, roughly, we brought in something like 400 million in assets, which is just batshit crazy for a brand new stablecoin. Excited for, what the next couple years and decades bring.
All right. Hey, everybody. Tyler Rowe back with the BitcoinTreasuries.net podcast. Today, I'm chatting with Parker White from the Apyx team. How's it going, Parker?
Fantastic. Thanks for having me on.
Of course, of course. So I think anyone paying attention certainly has seen how big of a story Apyx has been. How was the launch of Apyx so successful, and what's the demand? What did it look like from the start, and I guess how much capital were you guys able to attract so quickly?
Yeah, I think in the first maybe 2 months, roughly, we brought in something like 400 million in assets, which is just batshit crazy for a brand new stablecoin, especially considering how many stablecoins out there kind of recently and have continued to rug, unfortunately. And so people, just I don't know if it was the background or what it was, but trusted us. And we've since reduced the need for some of that trust with things like attestations and more dashboards and that kind of thing. But um, the growth was explosive early on. And I think a lot of that was attributable to, just the explosive growth in Stretch. So this was during the couple month period when Stretch and MicroStrategy was raising, billions off the ATM every couple weeks. And y'all's like treasury tracker was pretty wild, showing the amount that they were buying each week or each day estimated off the ATM. And so I think we kind of piggybacked off that hype. But we basically started writing our first lines of code in early January and shipped basically at the end of February. So shipped really fast. And I've tried to continue running at that same pace.
That's crazy. I guess how quickly you guys were able to ship from concept to execution was pretty wild. I met some of the team at Strategy World, and to see how quickly this thing took off was absolutely crazy. And maybe we can get into maybe a little bit of your background, Parker, and the background of the team. So can you maybe give us like the high level overview of your origin story and how you came to Bitcoin and involved with DeFi projects, and how did the rest of the team like, what's their story?
Yeah. So for myself, I grew up in a small town. I was homeschooled. Um, and very curious from an early age, and I'm a huge proponent of homeschooling. I love it. I'm certainly going to try to homeschool our kids, and this gave me some flexibility from an educational perspective to explore non-standard things. So when I was 12, I remember my dad gave me Hayek's Road to Serfdom. And so I read that, devoured that, and always had a very keen interest in finance from a young age. I remember when I was 16, I bought some AIG stock with my dad's brokerage account. And when the global financial crisis was happening, we spent a lot of time talking about my dad and I about currency and credit and the banking system. And I don't know if my dad would recognize it formally, but he's certainly an Austrian. Like this is how he thinks, this is how he approaches the world. And so then when I was 17, was starting to read a lot of books on like modern portfolio theory and the history of the banking industry going back to the 1800s. Um, and then actually I passed and got my Series 65 and investment advisor license, basically. So I remember my dad calling the SEC and FINRA saying, "Hey, like, can my 17-year-old son like take this test and get his license?" And they were uh, like what? Okay, I guess, I don't know. No one's ever asked that question, Um, and so when I was 17, had an internship at Merrill Lynch as well. Um, and so just very keenly interested in finance, but kind of like in the background had this like alternative view, this Austrian view. And so fast forward, first job in the TradFi world, doing a lot of bond trading and portfolio management stuff for a couple $1 billion asset manager, and stumbled upon crypto first in 2017. And I remember early 2017, one of my buddies telling me about this Ethereum thing. It was like this global app store, and it's going to replace the dollar. And I'm like, why do we need to replace the dollar? It seems fine. But then in late 2017, one of my buddies got me into a random ICO. It did really well. So I, of course, did what any good investor does, and I diversified my portfolio across a whole bunch of shitcoins. I do remember telling some people though that Bitcoin was boomer tech and it was going to die, and good times. So throughout 2018, I watched my diversified shitcoin portfolio all go to zero. Although I did buy a little bit of the some folks on here may remember ETH Lend, which was the precursor to Aave. So they rebranded to Aave. So that was, good times. But so fast forward, I had a little startup with some buddies in 2018 doing some algorithmic trading stuff in the crypto space. And then in 2018, at the end, joined Kraken. So got out of TradFi. I just finished up my CFA. And as everyone knows, that goes to the CFA, you have a work experience thing, and then you can like put the comma CFA on your name on your business cards. And I think it was like a week after my business cards finally arrived with CFA, I was like, I'm done with this, I'm out. Went to Kraken. And throughout 2019, I spent a lot of time going down the Bitcoin rabbit hole. And I remember my first, I don't know, like 10 or 15 paychecks at Kraken. I just took them 100% in Bitcoin because they have like a way to get paid in Bitcoin. And I was like, oh, this is so cool. I had an S9 that I bought on eBay, and I plugged it into the dryer outlet in my apartment because it was the only 220-volt outlet. And
Oh
so
man.
whenever my wife wanted to like use the dryer, it was like, all right, stop the S9 and like plug the dryer in. And one time I like kind of electrocuted myself, and it, I was like, not too bad. I was like feeling the tinglies. I was like, well, that's, I let go of that. But anyway, so I was all in, just so amped to be in, and like really going down the Bitcoin rabbit hole in 2019, and fundamentally began to understand what Bitcoin was about and how it was a return to the hard money standard. And it was really this solution to all of the economic and monetary problems that we see in the world that are all second order effects of, as the book behind you says, broken money. And so that was kind of this foundational year, 2019, learning about Bitcoin and why like all of finance is effectively broken. All of economics is broken. All of human society is a little bit broken. It's a little bit sick. We're walking around with like a light headache, every single person, a financial headache, because our money is broken. So then from there, I spent quite a few years at Kraken, didn't leave until early 2025. But I remember kind of exploring the DeFi space as well, because yes, money is broken, but a lot of the systems built on top of our money are also broken. The banking system and the trading rails and the finance rails and the settlement rails and the payment rails. These things are all like, they're all analog. And so I remember like talking to Hayden Adams over at Uniswap, or Hayden at Uniswap, and back when it was just him and his assistant. And I remember talking to Stanny over at Aave and kind of like the real formulative days. This was kind of DeFi summer of 2019. Um, and so realizing that, Bitcoin is money, ETH is not money, these other things are not money, but we can also build this like new layer on top of good money that is fundamentally better than the existing system that we have. So fast forward, again, spent a lot of time at Kraken in a number of different roles, some engineering, and also just always dabbling in DeFi. Um, and, in 2025, left Kraken with some and with some other Krakenites, some former Krakenites. We launched DFDV, which is the first non-Bitcoin treasury company, a DApp built on Solana, and then launched Apyx about a year after that. So really moving from the kind of the sidelines directly into the builder ecosystem, and that brings us to today, at least for me. And the rest of the team really has, I would say, a similar story. So Joseph, he was the CEO of the first Canadian Bitcoin exchange back in 2013. So he fundamentally understands money and understood broken money from a much earlier time. John, CFO over at DFDV and involved in Apyx as well. He had a Mt. Gox account. Pete, you guys know a lot of these people, but they all, have been in the trenches, have been building for quite a while. And we've been kind of doing this together at Kraken, some different side projects, and now with, DFDV and then Apyx. And they all kind of have this fundamental understanding and have been through multiple bear markets and kind of lean on that conviction, that fundamental conviction, that decades long innovation cycle that we're on to kind of continue to build, continue to stay locked in through these bear markets. And so that's really the team behind Apyx. And, we're here with a lot of conviction and really excited for, what the next couple years and decades bring.
That's cool. So it's really interesting, Parker. You've sat in the TradFi space. You've been on the exchange side with Kraken, the DAT side with DFDV, and the DeFi protocol side. So I guess there's probably a lot of misunderstandings between those various communities. Obviously, TradFi and Bitcoin and the broader crypto space. There's a big disconnect there. But there's a lot of Bitcoiners who are, I guess, probably skeptical of what's happening in DeFi, and like you said, even our traditional financial rails are broken, but there is value there, right? There is value to financialization. There's a reason it exists. What's your message to the Bitcoiner who maybe is skeptical or just hasn't taken the time to understand either what Apyx is doing or DeFi, in a broader sense?
Yeah, I think a lot of Bitcoiners are starting to come around more to the DeFi space, but what's kind of fun. I mean, ultimately, a lot of the Bitcoin maximalism is religious, and I do come from a religious background, and you just see all the same parallels, and you're like, whoa, this is like, it's a religion. It is like, that's exactly what it is. So some of it's not reasonable, and you can't really reason some of that away. But, what's funny to me, it was always funny to me, is when Bitcoiners would be like, DeFi is evil, and then they go pay with their Visa card, and then they use like a centralized lender to borrow, say, against their Bitcoin, something like an Unchained or, and then they go on a Kraken to buy their Bitcoin, and then maybe they use like a Lightning service provider to like pay over Lightning, and it's like, okay, well, maybe DeFi is evil, but all these things are centralized and certainly worse than a somewhat decentralized version of the same thing. So, it's just kind of disingenuous. Now, I will say that there are certainly lots of scammers in the crypto space at large, just like there are anywhere. There's been a lot of Bitcoin scammers, right? Every cycle, there's a group of Bitcoiners that peel off and go try to do their own fork or something, and we just got through that with the BIP 110. But there's lots of good stuff in there too. And there's never going to be a world where everyone walks around with, I'll have to say it, everyone walks around with their cold card and, like pays each other with Bitcoin from their cold card for every single thing that they do. Like, that's just not ever going to happen. There's, of course, lots of technical limitations, but like most normies aren't going to go roll 100 dice to like hold on to their money and then transact with it with punching in numbers on this like, kind of Android type open source hardware device. It's just not going to happen. And so once you accept that, then you realize you're going to need financial tools and rails. And is it better to have those things be fully centralized, or maybe not as decentralized as Bitcoin but still somewhat decentralized? And I would vehemently argue the latter. And so you don't have to run around saying, well, I'm going to sell my Bitcoin and buy Sol because Sol is money. Like, no, Sol's not money, but you can still get benefit from these platforms. And just think of it like, you're putting your Bitcoin onto, Schwab to borrow against it or to trade derivatives on it, sell covered calls to generate some income, whatever you might want to do. Instead of thinking about it that way, just say, okay, instead of Schwab, I'm going to put it on Solana. And then, it's the same thing, but it's just like a upgrade from Schwab on almost every level. And so I think it's kind of, and maybe the whole ETH is money crowd, like really, caused a lot of problems for this view. I think that crowd has mostly been wiped out, or have changed their tune. But like, I think for most folks, you can kind of move beyond just holding your Bitcoin in a cold card with, a bunch of dice rolls. And these DeFi platforms are just strictly better than, the corresponding centralized. So that's kind of some thoughts there.
Yeah,
It's not for
yeah,
everybody, but yeah.
yeah. I think you kind of nailed like a key point on the head. Is I think a lot of Bitcoiners, there were narratives that ETH was a direct competitor to Bitcoin. In a sense, it was. And Solana, it's like if someone finds Bitcoin as a compelling store of value, because transactionally some of these things are happening on a different chain, they kind of associate the programmability of these other chains with the asset that sits on top of it. So I think that's where like maybe some of the disconnect came from. So for someone out there who's maybe just like dipping their toe into DeFi, or experimenting with things, how do you identify how not to get rugged? Like, that's a big question and a loaded question. But there is a comfort in traditional rails and traditional products that people have, because it has a track record, because the crypto space does have such a short track record. I guess, how do people prevent, some of the horror stories, and what have you done at Apyx to, kind of put people's mind at ease that this is something that really provides value to people?
Yeah, so I mean, a lot of the same principles apply. Don't trust, verify, right? So, um, self custody is the way to go. Don't use a web wallet. Don't use a browser wallet, and just like have the keys stored in your browser extension. Like, hook it up to your Ledger, hook it up to your Trezor. That's the way to do it. It sucks to click your buttons each time, but like, it's just a better way. Like, this is the same thing that Bitcoiners always have been doing and have been preaching about doing. Sure, maybe you got to use a Ledger and a Trezor instead of using your cold card, but I don't know. Maybe after the cold card stuff, you should be using a Ledger and a Trezor anyways. I don't know. Anyways. So start there, and then you can stick to reputable platforms that have been around the longest and have the greatest size. So these would be, from a lending platform perspective, things like Aave, things like Compound, Morpho. Those are on the Ethereum side. On the Solana side, Camino, Jupiter. Doesn't mean that one of these things can't, have an issue, but like, typically your largest platforms, they have the most money to spend on security budgets. They've open sourced their code. So you can take a look at the code. I know a lot of people don't like to review code. They just kind of trust it, but like go spend $10 on Fable with Claude Code, point it at the repos and be like, find me any bugs here, right? Like that can be done now. You can do your own little security audit. But most of these things, they've had lots of security audits done. You can go read the audits, the outcome of the audits, how many findings were there, how quickly were they addressed.
It's official. The Bitcoin Treasuries conference lineup just dropped. Grant Cardone, Adam Back, Eric Weiss, the man who introduced Saylor to Bitcoin in the first place. Plus, the CEO is actually running the treasury companies and the macro voices calling out where the institutional capital goes next. 10 confirmed speakers, 1 closed-door room, September 28th in New York at 2nd. Save 10% on tickets today by using the code SECOND. Reserve your seat by scanning the QR code on the screen or visit bitcointreasuries.net/conference. We'll see you in New York.
Some basic stuff. Diversification's obviously also a good one. And this applies to all areas of your life, right? Like maybe don't keep all your money in Silicon Valley Bank because one weekend you might wake up and it's like, shit, doors are closed, right? So this is not just a DeFi story, but like, if you want to borrow against your Bitcoin, borrow a little bit on Camino, borrow a little bit or borrow against it a little bit on Jupiter Land, maybe a little on Aave, whatever, spread it around. That's the only surefire way to know that the platforms aren't going to have issues. Aave had some issues earlier this year. They worked through them. But that's kind of, I guess, good advice for any platform. TradFi, DeFi, whatever. So I think those are some good ways to kind of get started and take that same mindset that you would, the adversarial, don't trust, verify mindset that you would take with Bitcoin and just apply it here. And, kind of dip your toe in and start slowly.
Yeah, makes a lot of sense, Parker. So, I think with the advent of STRC, Michael Saylor's preferred equity over this past year, and being able to see how much capital has really flowed in this year. Obviously, at the time of recording, it's still struggling to get back to par, but it's time of recording where it's within striking distance. It's 4 to 5% off. But Saylor, I've heard you talk about this. Saylor kind of found a way to bring yield to Bitcoin. And I've heard you talk about, getting attractive lending rates on Bitcoin is hard. Obviously, we all know Saylor's story with strategy. They did some traditional financing to add some leverage to their balance sheet to buy Bitcoin. Then they went the convertible note structure. Can you walk us through why STRC was such a game changer and how you think Saylor came to realize that?
Yeah, well, I think ultimately he arrived at it via trial and error. And I think, what he's been doing is kind of going from niche to less niche. So convertible bonds are the most niche area of the credit market. Maybe not the most, but pretty close to it. Only some big hedge funds play in it. So they're 144A securities. You have to have at least 100 million in assets to even be able to buy 144A securities. And so there's like 70, 80 buyers or funds on the planet that will even touch converts. So he tapped out the convert market, dominated it, most liquid convert issuances on the planet. All right, cool. What's next? Preferreds. And so he tried a few different structures there. I guess fourth time's the charm, and has now dominated the preferred market. The largest, Stretch is the largest, most liquid preferred ever in history. And so I think it's really at a fundamental level, he believes long-term in Bitcoin, and he wants to figure out ways to access capital cheaply via credit markets to fund more Bitcoin purchases. It's that simple. He just has a lot more mechanisms to do so than the average person because, he runs a public company and now a pretty large one. And so I think arriving at Stretch was a bit of a trial and error game. Lots of time with ChatGPT or, maybe Perplexity's model council to see which one gave them the best ideas or something. But, and then they just saw the thing that was working and then just started marketing it. And, the powerful thing about Stretch is, and the problem with the converts is that the converts mature. And so you might be stuck in a situation where it's maturing when Bitcoin's way down and you have to pay it all back. And that could be a big slug. And it might not even be that it's maturing when Bitcoin's down, but the maturity date is looming when Bitcoin's down, like we have right now, and people are freaking out about it, right? Stretch and these perpetuals never mature. They're perpetual. And so even though the dividend rate is higher, 12% versus, 0 on the converts, there's no maturity date. And so if you amortize the maturity, so let's say it's a 5-year bond, coupon is 0, the rate that you have to pay it back, it's not actually 0%, it's 20% on a 5-year bond if you amortized it linearly. And so from that perspective, a perpetual paying 12 is actually cheap financing. Now, it doesn't line up exactly because perpetual, it keeps going. You owe 12 forever, although it's variable rate, so they could lower it some. But, the point stands. But you never have this cliff. You never have this bullet where you're like, I have to refinance or pay the money back, and that could come at a bad time for Bitcoin. Bitcoin does what it's going to do in the short term. And so I think, the perpetuals provide a much safer level of financing that he basically can't get liquidated. With a convert, the worst kind of margin or borrowing against your Bitcoin is like a margin loan, because your duration is effectively like 1 day or a couple days, or if it's in DeFi, it could be like instantly.
I want to talk about something that comes up in almost every conversation I have with Treasury executives. They get the Bitcoin thesis, they see the macro case, but then they walk into a board meeting and the first question is, who's holding it? Are they regulated? Are they insured? Can we audit this? That's where BitGo comes in. BitGo is an OCC-regulated national trust bank. That means they operate under the same federal oversight as the institutions your board already trusts. Your assets are held in segregated trust accounts, never commingled. They're secured in 100% cold storage with multi-signature architecture. If you're building a case for Bitcoin on your balance sheet, BitGo is the custody partner that turns a board conversation from why into when. Visit bitgo.com/Bitcoin-treasury to connect with their team.
You wished for it. Bitcoin is finally on sale. And if you're sitting on BTC and want liquidity without dumping your stack, Arch Lending can make it easy. You can get USD or USDC in minutes, and your collateral stays in qualified custody. They never rehypothecate your assets. As your assets move up and down in value, you can scale your credit line instantly or pull the collateral back when the market runs. If you need help, you get real humans 24/7, not bots. This is Arch Lending. Simple tiers, public pricing. You can check them out at archlending.com.
Or like perpetual swaps on a CFI exchange, it could be instantly. So that's bad. So you stretch the duration or the maturity to 5 years on a convert, but still 5 years is like, it's far better, but it's not perfect. You take the perpetuals and you stretch that far further out, duration of 10, 15, whatever years, and no maturity. And so it just makes the capital structure much more robust, because there's never this moment in time where it's like, if they don't figure everything out in this 1 year, then like it all unravels. That's not the case here. And so the preferreds for them is just a fantastic instrument to issue. Now, it also solves a problem for the buyers, though, and that is, how do you get some exposure to this whole, I'm going to speak like a credit investor, how do I get exposure to this whole Bitcoin's phenomenon thing without trying to buy Bitcoins in my account and set up a Coinbase account or a Kraken account and then like fiddle around with this 2FA thing. And like, if you're an advisor, like it's a total mess, right? For like normie 50 and 60-year-old investors, retirees, institutions, funds, pension funds, mutual funds, that kind of thing. So, historically you got exposure to crypto by, buying some Coinbase stock, in your account. Then you had the ETFs come along, but you can also buy MSTR. But now you've got like a yield bearing instrument and it's a stock, so it's got a ticker symbol and you can buy small amounts of it or large amounts of it. It trades. It's very liquid relative to converts or almost any other credit instrument. And so for credit investors or just regular investors that want exposure to the Bitcoin narrative, but want to do so in a less risky, lower vol manner, Stretch is a great way to do it. And I know people say, well, Stretch is just as volatile as Bitcoin. No, it's not. Yes, it fell, 30%, but it rebounded right away. And by the way, Bitcoin, when Stretch fell 30, Bitcoin was down over 50 from its all-time high. And if you'd bought Stretch back when Bitcoin was at its all-time high, and held through that period, you were only down like maybe 10% because you've been collecting dividends all along the way. And now you're back up to within 5% of par, and you've been collecting dividends all the way. So you're definitely back in the green or back in the black. And Bitcoin's still down 50%. So it is far less volatile than Bitcoin. It pays you income along the way. And you got these cool tax benefits as well, tax deferral. So lots of reasons that a traditional investor might want to buy it. So it's kind of a, win-win for both parties. Great for strategy, great for the buyers, and that creates a successful product. This is capital markets. This is capitalism, where two willing parties create a product and transact on a product that benefits both accretively, and that's why you have the most liquid, preferred stock ever in history.
Yeah, when you talk about the investor there who's looking to get exposure to Bitcoin, doesn't really know what it is. They just know it's investable. It's got now the the investment bank stamp of approval. There's ETFs. It's been mainstreamed in a lot of ways. It's not in the mainstream, so to speak, but it has been massively mainstream compared to where we were back, in 2017 when you first came into the space, obviously. And these last 2 years have just seen really explosive growth in the infrastructure, I think, in the traditional finance perspective. So when you're telling that, going through that scenario, I couldn't help but think, man, aren't some of these investment banks or like brokerages going to try to do the same thing at some point, where they can give their clients exposure to Bitcoin in a low volatility way and allow them to earn a yield? Does that seem inevitable to you, Parker? Because we've talked before about the pref market. There's probably not a ton of room for the nth company to come in and compete with strategy, but do you view like brokerages, banks competing with strategy maybe someday on this?
It's a good question. I mean, it's going to be tough to compete directly with strategy. I think what you're going to see is them offer more financialization around Bitcoin and Bitcoin linked products and Bitcoin derivatives. So this would be things like offering more margin against maybe first the ETF, then Bitcoin companies, and then just straight Bitcoin itself. A lot of the brokers have started adding direct spot Bitcoin. So like on Schwab now, you can like just go straight buy Bitcoin. Like you don't have to buy an ETF. You don't have to buy strategy stock. Like you can just buy actual Bitcoin if that's what you want, and supposedly like take custody of it yourself. And so I think generally there's just going to be a lot more products offered on Bitcoin by these brokers, these banks. You're seeing a lot of more on the OTC side, but banks like Goldman and JP Morgan offer these structured products on Bitcoin. So there's a lot of these, they call them like structured notes, where it's, let's say, a 5-year maturity, and you get 50% of the upside on Bitcoin and full downside protection. So if Bitcoin is up 10%, you make 5%. And if Bitcoin is down 10%, you don't lose any money. And so they're using the options markets to structure these products, packaging them into these notes, and then issuing these notes. And so back in my TradFi days, we would do all sorts of these things linked to the the S&P or the NASDAQ, and clients liked it, right? They liked the idea of some of the upside, no downside, or double the upside and like half the downside, or whatever. There's like 15 different flavors of these things. So these guys are starting to structure these products, and I think you're going to see a lot more of them. And so there's just going to be, rather than one way or two ways to express a view on Bitcoin, there's going to be 37 ways to express a view on Bitcoin. And that's great because everybody with differing views creates a market, and that improves liquidity, and that makes the asset even more investable for larger and larger institutions, moving from, the banks and the brokers to like sovereign wealth funds, and then like central banks being able to build positions because the market is so liquid. So it's just a general financialization and liquidity march that we're on. And, these things take time, and TradFi moves slowly. But, it's at this point feels pretty inevitable.
Looking at Bitcoin's chart over the past year, we've seen some clean structural trends. Most of you hodl long-term like I do, but to trade short-term moves, the easiest way is with Kalshi perps. Sometimes I'm sure that next leg in Bitcoin's price is just around the corner, and perps allow me to position for that exact scenario. Kalshi has a CFTC-regulated U.S. exchange that are bringing perpetual futures to American traders for the first time. Perps let you trade Bitcoin's price movements up or down with no fixed expiration dates, unlike typical futures contracts. So I could take my leverage up to 6x without even holding spot, and that can amplify both my potential gains and potential losses. Leverage trading obviously isn't for everybody, so carefully consider your own financial circumstances. Scan my QR code on screen or sign up at kalshi.com/p/Bitcoin Treasuries. And as always, make sure you trade responsibly and don't forget to stay orange.
When we think about Stretch, like you said, it was a real unlock to be able to come up with this perpetual product where the principal didn't have to be paid back for strategy. What do you think about the ceiling of STRC? Obviously the preferred market is small, relative to the overall, income markets or bond markets out there, and obviously it's a lot smaller than the broader equities market. How much, I guess, how much investment and capital could strategy unlock with these prefs, and are they going to have to find the next thing? How quickly would they have to find, I guess, the next thing to continue their strategy? And what signs would you be looking for, Parker, to see that Stretch has kind of hit a ceiling?
Yeah, so I'd say the traditional wisdom would be like, well, they've already kind of tapped out. They are like the largest preferred stock in the market. But I think, and I had a good chat with Fong about this, I think they've actually completely changed what the pref market can be and is going to be going forward. Because historically, credit instruments were, mostly 144A. So you mostly had these big institutions. Retail could get access to them via ETFs or via mutual funds. And sometimes a broker would offer some bonds, on a one-off basis, but they're not liquid. It's basically, as a retail investor, you buy and hold to maturity. And you have to do round lots. So that means buying $100,000 clips as a minimum. So for the first time, we have a credit instrument issued directly from an issuer to buyers that you can pick up. You can buy, fractional shares. You could put $10 into Stretch if you wanted to. Forget the Bitcoin backing. That's revolutionary. And going back, I'm going to go on a little tangent here, but going back to my background around, broken money and all of this, I think this like mega, lifetime trend that we're on is democratization, access to everything. The printing press started this, and like we're continuing down this march, and that march is accelerating. So obviously the internet really accelerated it with information. Bitcoin accelerated it with hard money. Crypto's, DeFi is accelerating it with finance. AI is accelerating it with knowledge. And so part of this trend is just like it's access, right? And it's not just a DeFi phenomenon or a crypto phenomenon or an AI phenomenon. It's everything. So, Robinhood is part of this with, the reduction in commissions. Schwab before them was part of it in like the online brokerage kind of move and revolution. And so I think strategy is kind of like stepping into this trend from multiple angles. They're stepping into it from the Bitcoin angle, but they're also stepping into it from the access to financialization, access to credit kind of angle as well. And so if strategy didn't do it, I think somebody else would have revolutionized the preferred market, because it just makes so much sense. A stock trading everywhere, that you have a ticker, you can punch it in, you can buy it, and it pays a yield. That it looks kind of like a bond. In fact, it almost looks entirely like a bond. A lot of prefs aren't perpetual. They actually have a maturity date. So it's not exactly like it looks more like a bond than a stock, but like anyone can buy it. You can buy it on Robinhood. This is sweet. This is amazing. This is a very cool piece of innovation, regardless of the Bitcoin piece. And so you bring in the Bitcoin piece, and it's like double innovation here. And so back to the question about the upside potential, that's really tough to, I think, fully estimate. And I guarantee you that strategy has no idea what the ceiling is, because they are redefining the category, and there's actually no reason really for the preferred category to be a niche instrument. And you could foresee a scenario, and I've talked about this before on some of your live streams, you could foresee a scenario, especially with all this, giant AI CapEx build out, where all of your major tech companies issue a preferred. And they're like, hey, we've got our common stock. It pays no dividend. It's all focused on growth. But then we have a preferred stock. And this is a way that retail investors can get access to the credit stack. And it's a way for them to finance all of this AI build out. And so in that world where the preferred category grows by 100x or 1,000x, Stretch could easily be a $100 billion, multi-$100 billion instrument and not be at the ceiling. Now, that's probably going to take some time, but I guarantee you the likes of NVIDIA and Google and Micron and all these guys know what strategy is doing, and they're looking at it. And I think it's going to be one of those guys, maybe it's SpaceX, they're pretty innovative. One of those guys is going to come out and be like, we're issuing a preferred, and it's like an AI-backed preferred. And then that's going to be like the catalyst for recognizing that this category is about to go 100x in size.
Yeah. I was gonna ask you what the catalyst, like, is strategy, raising an insane amount of capital in the next Bitcoin bull market a catalyst for one of the big players to take it more seriously? Or is it just, they're doing their due diligence, the finance teams at like a SpaceX, like you said, is that going to drop the hammer? Because like, I could see it being like a arms race, for, once one big company does that with success, there's going to be more indexes rolling out, and, the waves of these, trends kind of play out in traditional finance. There's times when SPACs are really hot. There's different categories of investment that become, really hot. Obviously, the AI sector, the chip sector has had its time in the sun the last few years. So yeah, I do wonder if like prefs can just, have their moment in the sun. It's pretty interesting to think about. And if that happens, it just benefits everybody who's in that space, right?
Yeah, for sure. And I think it's a time thing. I think most of these finance departments are aware of strategy. I don't know if they're doing their homework yet. But and SpaceX and Tesla are great examples, right? They have Bitcoin on the balance sheet. Like they've shown willingness to be very creative from the corporate financing perspective. And so, but in traditional finance, like time, as you mentioned earlier about not getting rugged, like time applies to everything, and people don't feel safe with, big institutions don't feel safe with Stretch because it's just not been around for that long. But, everyone's kind of watching it. And after, 18 months and 24 months go by and it's starting to work more and more, and strategy irons out the kinks and figures out how to keep it, mostly stable, these guys are going to be watching and they're going to see the growth. And at some point, someone's going to kind of cross the line, it's going to jump, and that's going to like really open things up.
If you're building or managing a Bitcoin treasury, you need institutional infrastructure to match. BitGo is the digital asset backbone trusted by thousands of institutions worldwide, offering regulated custody, OTC trading, financing, and settlement all under one roof. They're now a publicly traded company on the NYSE and hold a federally chartered national bank license from the OCC. For Bitcoin treasury companies, this is the infrastructure layer that matters. Learn more at bitgo.com. The dip is here, and with it, you might be thinking, is it time for me to borrow against my Bitcoin? Enter Arch Lending. They're building the most transparent borrowing experience in crypto. We're talking industry-leading rates from 8.49% when you borrow against BTC, and you receive USD within minutes. Your assets stay protected with qualified custody, there's no rehypothecation, and verifiable segregated addresses are used always. As your collateral grows, you can unlock more liquidity, adjust your line anytime, and extend your term with a single click. And with 24/7 white glove support, you're never going to feel like you're on your own. Arch Lending, simple terms, public pricing, market-leading rates at every size. You can learn more at archlending.com.
And it's tough to say exactly when that's going to be. It's probably going to be sometime in the next bull market when strategy raises another 10 to 15 billion. And, some AI company somewhere in the stack, maybe it's a neo cloud, maybe it's, one of the hyperscalers, maybe it's a chip or a semi. They're going to maybe be struggling a little bit to raise capital on the, from the institutions. And so they're like, you know what, let's go try this, this pref thing, and it's going to work. And then everyone's going to go copy, and, it's going to be a total blowout in terms of, attention here. So, it's tough to say exactly when that catalyst is going to occur, but, I think it's coming.
Yeah. Maybe it hasn't happened yet because the money is flowing so much to those, sectors right now. But yeah,
Sure.
if the spigot stops there, I could definitely see people, tapping into prefs. Could we talk a little bit before we wrap here, Parker? What, this latest test in STRC's price, what do you think Saylor and the team have learned from that? Is there anything they can do to prevent, these spikes and drawdowns? Maybe there was, big short interest on STRC, inextricably it's going to be linked to Bitcoin's price sometimes, the fluctuations and the volatility in Bitcoin's price. And, sentiment's a tough beast to tame. I guess, what do you think strategy learned from this? What did the team at Apyx learn throughout this? And maybe you can get into some of the mechanics of the pegging of Apyx and the stable coin and the yield coin behind that. And is that always going to be, pretty much pegged to STRC? And what can people expect there?
Yeah, great questions. Couple things to unpack there. So, on the strategy side, I think they tried a bunch of things to help get the price back to par, and ultimately buybacks are just what they got to do. But what's interesting is it actually didn't take that much on the grand scheme of things in buybacks. They've been buying back, about 100 million a week now. Last week was 108. Week before that was 80. Week before that was like, I don't know, 25 or something. So I assume they'll be doing something like 100 a week for the next few weeks. But like that, in the grand scheme of things, maybe they end up spending 500 million to bid it back to 100 in, at the bottom of the Bitcoin bear market. That's 5% of the total supply. That's not too bad. And so I think probably what they need to do going forward is just maintain basically a buyback reserve. And it sucks, right? Because you're not holding that in Bitcoin, and Bitcoin goes up 30%, and you're like, well, that's just idle cash sitting around. But if that allows you to issue the next, $10 billion a Stretch, and then you put most of that into Bitcoin and a little bit into like a buyback reserve, it's ultimately altogether allowing them to buy a lot more Bitcoin. But I think just basically saying, look, we'll step in and defend the price, that creates some kind of moral hazard type potential problems, and people starting to loop it and lever it, and then they're gonna like play the role of central bank. But I think that's ultimately what just what they have to do here, and inject enough uncertainty to kind of remove some of that moral hazard. But you have to be prepared to buy it back and maintain a little bit of that kind of buyback reserve, if you will.
Do you think that buyback reserve is better left in dollars rather than Bitcoin?
I think, look, if they can get the market comfortable with leaving it in Bitcoin, then obviously they should keep it in Bitcoin. But I think for the near term, the market's not comfortable with it being held in Bitcoin, and so they just hold it in cash. And it's not great, but it's not that much of a reduction to the overall total return of the book, having a couple $100 million extra sitting in cash. So I think they'll have a mix, and you've even seen that in their like earnings report where they talk about their Bitcoin reserve and then their cash reserve. And they're always reminding people, hey, we can always tap the Bitcoin reserve to do the buybacks. And I think it's very instructive that they're actually just selling the exact amount of Bitcoin that they need to do the buybacks, because they're trying to educate people, look, we can use Bitcoin to do these buybacks. It's not a problem. But I think they'll have some cash reserve in the short term to, next couple months, quarters, whatever, to comfort the market. But then over time, I think they'll slowly work that down.
This episode is brought to you by Kalshi. And here's what keeps bringing me back to Kalshi Perps. I don't sell my Bitcoin, ever. But there are weeks where I've got a strong short-term view and no clean way to act on it. That's the gap perps fill. Kalshi is a CFTC-regulated U.S. exchange, and it's the first time Americans can access perps on shore. You take a position on whether the price goes up or down with no fixed expirations. You close when you want, and I can go up to a 6x multiplier, which amplifies both my gains and my losses. So I size small, I set my stop before I open anything. Leverage trading isn't for everyone, so carefully consider your own financial circumstances. Scan my QR code on screen or sign up at kalshi.com/p/Bitcoin Treasuries. Trade responsibly and stay orange.
Or maybe just grow out of it so they don't actually spend it. They just like accumulate. They issue a lot more Stretch and like don't grow the cash reserve proportionately. And just keep harping on, look, Bitcoin can be used. It's not this dead asset that's just sitting there. We can sell it if we need to, get people comfortable, and then, they'll be off to the races. So I think they're solving a short-term problem with the cash reserve, but ultimately I do think buybacks are going to be their primary tool in the future to support the price. And I think I don't want to say never, but I don't think they're ever going to let it get down to the 70s, maybe even the 80s again, because it just damages the narrative so much. And they've shown that a little bit in buybacks is all that it takes to kind of keep it from getting there. So,
Yeah. Yeah, and we're coming up against our time here, Parker. But can you maybe talk about the knock-on effects with Apyx, and maybe just give the high-level overview of APX USD and APY, and why the two tokens split, and how I guess how STRC's price can affect that.
Sure. So ultimately, Apyx is a wrapper around digital credit, primarily Stretch. And we've added some things to try to reduce the volatility. We have about 15% cash in the book right now. That may change over time, increase a little bit, maybe decrease a little bit. There's some other mechanisms that we can introduce to further reduce the volatility. So we are working on those, and we'll have some announcements hopefully here pretty soon. Although we mostly like to announce things once they're live, not like pre-announce the announcement kind of thing. So we're working on some of that, but ultimately, we do want to make sure that we tie our fate to largely, the digital credit ecosystem, because we think it's going to do really well. We think it's going to grow. We think the stability is going to increase. And so we don't want to introduce mechanics that eliminate all the downside, but eliminate the upside, and the upside being the yield. So we could fully hedge out our Stretch today. Well, the best way to fully hedge out all the Stretch today is just not have any. And then you're just yielding 3.5% or whatever the T-bill rate is. And well, that's boring. And so, there's things that we can do around the edges to reduce some of the tail volatility and reduce some of the overall volatility. But ultimately, what we're building is tied to the digital credit narrative. But we think some compelling advantages over digital credit directly, especially on chain. So first off, it's access, right? Anyone in the world can go out and buy it on DeFi. There's a number of restricted geos that we can primarily interact with, but once it's out there, we don't control who touches it. Beyond that, it's fully integrated into DeFi, so you can, borrow and lend against it. You can loop it. You can trade it. You can, get perpetual margin. So you want to trade perpetual swaps, you can use it as your collateral. There's all sorts of different things that you can do with it. You can pay for stuff with it if that's what you want to do. So there's all sorts of benefits to it being this kind of composable DeFi available asset that Stretch in your brokerage account just doesn't do. And it's also far more liquid than any tokenized version of Stretch today. So Stretch X or Ondo Stretch, whatever, there's just not nearly as much liquidity there as there is for, APY or APX. So lots of reasons for on-chain users to hold it. And also lots of reasons for non-on-chain users to explore it, because it does offer some benefits and advantages over just, say, holding it on Robinhood or, Schwab or what have you. Again, being mindful of those restricted geos, of course. So this is kind of, what we're building with Apyx, why it's compelling. Come check out all our stuff, and you can see all the other bull posts on it and explainers. But it is ultimately a structured kind of wrapper around Stretch and digital credit. And so for better or worse, we want to keep it that way and kind of ride the wave that Saylor has been creating.
Love it. Love it. Great to see, something being built around Stretch so quickly after it launched last year. And I think the upside is certainly, incredible, has incredible potential. Parker, tell everyone where they can track you and follow you online.
Sure. Yeah. So our website, apyx.fi, apyxfi on Twitter. And then you can follow me personally at @theotherparker_. So yeah, come check us out. We're stoked to meet you.
Great. Awesome. Great stuff as always, Parker. Really appreciate it. One thing I have all my guests say before they leave is stay orange.
Stay orange. All right. I like it. Stay orange.
Love it. Ladies and gentlemen, Apyx's Parker White.